afternoon, good morning, good evening, welcome, no matter where you are in the world. This is Take Stock Live. My name is Sam Evans. I'm your regular host of the show every single Thursday at noon Eastern Time here on Facebook Live. And remember, Take Stock Live is powered by Stockability.com. Thank you, Stockability, for being the power behind this, whatever that means as well. I hope you're having a great week. Today, it's May 13th. 13th, unlucky for some, but not the markets. Wow. What a rally in the markets we've seen today. Huge sell-off. Big, strong bounce back. Is it a full recovery? I don't know. I feel like this market really needed a correction. And we saw a couple of downward days of maybe some correction on there as well. I'm still in the world of buy the pullbacks. My guest today is lead coach at Stockability, Ryan Watkins. I know he loves buying those pullbacks. That is his mantra over the last couple of years for sure. In fact, probably even longer than that in this bull market. But today we're not going to be talking about just buying pullbacks for short term. We're going to be talking about buying pullbacks for long term. Today, we love a good top five, Ryan and I. And today's top five is the questions that you should be asking when planning for retirement. Now, you may be looking at the show right now thinking, planning for retirement? I'm nowhere near off that. Well, guess what? It creeps up on you quicker than you may think, especially when you've got a lot of fat kids running around the house as well. Guys, it's never too early to plan for retirement. It's also never too late to plan for retirement. The scary thing is when you do nothing, and there's questions that you should ask, but the sooner you get a grip on this thing, the better it's going to be. And that's what I want to talk about today. No matter where you are in the world, how do you plan for retirement? What are the top 5 questions that you should be asking when entering this realm? Take Stock Live is all about answering questions, informing you, educating you, empowering you, and more importantly, just as well, entertaining you as well. To ask those questions that maybe you've never asked before as well. And that's what we're here to do as well. Joseph Solanas, good to see you, a regular viewer on the show. So I hope you're having a great week so far. This is a live show, so before we get into that meat and content, remember that you can contact us live on the show by typing in your comments as you're looking at this here on Facebook Live. And if you are watching this recording, thank you for taking the time. If you can't stick around for the whole show, remember this show and all the previous shows can be found here on the Stockability Facebook page, and also you can go to the YouTube channel, Stockability's YouTube channel, where you can actually find all the previous recordings of the show as well. So before we bring Ryan on the show, who's going to be joining us from Georgia, let's go see where the market is at. How are we faring today? Let's go and pull up the data and see right now. I'm going to just basically go look at the scores on the doors right now so you guys can see them, so we can see them all on here as well. And I'm going to highlight with my fancy new cursor tool so you can see everything. Up to date, 46 handles on the S&P right now. S&P up 46 handles as we speak right now on the day. Literally trading right now at 4,100 seems to be the big number that we're seeing on here as we zoom in on this. Dow Jones Industrial Average Futures up 418 points. I remember we were down about 700 odd at one point yesterday. 400 points. That's a decent bounce back. Now trying to grip the 34,000 mark. Remember, 33 was the big number. Now 34 is we did touch 35,000 last week. I think I remember on the show saying literally last week, Dow 35,000, here we come, but we did not hold it, and we had a huge sell-off all the way back down again, but now bouncing back, holding stable on here. I think question today is, will the Dow hold 34,000 going into the weekend through trading tomorrow and into there as well? The tech sector, NASDAQ has been taking an absolute beating as of late on here. Up 100 points today, though, NASDAQ at 13,102, you can see flashing on here as well. And the kid brother, the Russell, at 2150, up 20 handles today as well. Volatility slightly down, the VIX down ever so slightly today with this as well, but it's still seeing a nice push on holding of gold at 18,000 on here as well. Crude oil at testing around the $64-65 mark as well, kind of nonchalant with $2 down on the day, but the uptrend still alive and well. And again, some general weakness in some of the big stocks, but bouncing back today as well. Not really the bounce back that I'd like to see, but bouncing back nevertheless as well. So, yeah, I mean, let's just go look at the actual charts so we can see it as well. Again, for me, uptrend is still in place. Here's your S&P 500. Nothing really to be too concerned about with this market. As we can see, the uptrend is still alive and well. When I look at it, all I see is just a pullback for potentially higher push to the upside on here as well. So, to me, absolutely, I see this, Hollis, as a buying opportunity. That's what I've been looking at. I've been waiting. I think that NASDAQ I think people got too carried away with the NASDAQ and the tech sector overall. Let's go take a look at both the futures and the ETF. And I'll have to get Ryan's opinion on this when he comes on. But this NASDAQ here, again, look, it needed this correction. But look, when we look at it, the uptrend is still in place. And to me, you know, we've got a significant buying opportunity area right around here. For me, I've dipped my toe in the water, bought calls on the QQQ just to dip my toe in the water. But remember, this has been, it's like the rest of the indexes have had to catch up with the performance of the tech sector over the last year. So there's definitely a little bit of a slowdown. But look, this is kind of normal. Look at the previous pullbacks that we saw on the market here, and here. Is this really any different? Every single one of them has resulted in further upside. I like dipping my toe in the water with the call options though. Do I want to put my hard-earned full cash into this? Not really, but the call options give me a much more limited exposure to be able to get into this in this particular way as well. So I really like that on the QQQs. So again, that's the NASDAQ that we're looking at here. If you want to go and look at the actual QQQs, you can see the same thing around here. So this area as well, a key buying area here. We had a good high from this area. If this holds, then I see probably a little bit more downside. This is a good area for me to take a little dip in the toe water. It's a pullback. I've got to go with it and see what happens. Let's go look at that Russell right now and see where we're at. Again, Russell at the bottom of its range. As you know, if you've been a regular viewer of the show, this whole area that we have been seeing here is just been one range on the Russell, sideways on here. We're just at the lows of that range. See some decent support coming in around here as well. And if any of you are looking at where do you think it's going to go, I got to be looking at 2200 to 2220. That's the equilibrium point. No reason why that range won't hold out. But again, I say this to you now, if this range doesn't hold, we will see more downside in this market as well. So I like, Hollis, personally, I like using the actual sector itself. I like using the broad market rather than the individual stocks, because right now I feel there's safety in using the indexes, okay? By using the QQQs or the NASDAQ, I'm going to be taking out and diversifying a little bit because, again, overall those markets are high. There's markets like Tesla, which are dragging down hard at the moment, not really so overbought, that are a big part of that NASDAQ as well. By actually having the tech sector itself or having the QQQs, I feel a little bit more diversified because I've got some of the big boys to hold that up if this thing does go a little bit lower as well. So that's why I like those broad markets. Great question, by the way. We are here to help, and these are all the kind of things that we should be talking about on the show. Finally, let's look at the mighty Dow, which is my weapon of choice that I love to trade every single day. And again, it just screams to me of yet another decent pullback or a buying opportunity here. What I like about this is it does have room to go to the upside right now as we speak. But I will say this to you, I'm going to draw a line right here. If we can't get and hold above this 34,000 point, then we're probably going to see a push down a little bit lower in this market. But again, I'm not writing this off. If we come back down to this 32,000 area, that's exactly where I'd be a buyer on, a second opportunity to buy. Might even join that on the downside a little bit from there, but that's the markets that I'm looking at right now as hell. No real reason to write that off at the moment. Again, and again, I could be wrong. Take Stock Live is about putting it on the line, saying what we feel and looking at these charts. And if you don't like it, that's fine, go elsewhere. The point is this, is I don't care about being wrong. The instructors, the coaches here don't care about being wrong. This is just opinion. This is for educational and entertainment purposes. I'm not a registered broker. You go ahead and do what you want to do. But the point is this uptrend in this broad market has been lasting. I'm not afraid of a pullback. I'll have a go. I'll just use a vehicle like options to dip my toe in the water and do it a little bit safer. Volatility's on the rise, so we want to make sure that we're actually protecting ourselves in that as well. Okay. You can use leverage, Joseph, by using actual leverage on the vehicle by using a leverage account. Okay. But I like to use the options, and by using the options on the likes of the QQQ or the SPY or the DAI, I get the leverage through the options with limited risk. So rather than use leverage as buying the stock outright by getting 2-to-1 overnight, I'd rather use the options on those ETFs. Hugely liquid, much safer way to do it. That's how we teach it at Stockability. If you want to know, that's just, again, the simpler approach to it rather than just using leverage cash. Use leverage by the option. That's one of our ways of doing it. That's what we like when trading these markets. Okay, so there's your broad market overall that you've seen on here. What else has been going on in the world? Why don't we go and take a look and see what else has been going on? What is driving the headlines? Obviously, yesterday, the big news coming out was inflation. Okay, guess what? No surprise, there's inflation. That is what they're putting down the sell-off that we saw in the market over the last 2 days down to. Is it going to catch up on us? Do I believe that this market's going to go up forever? Hell no. I will go on the line and say that. My colleague, my guest today, Ryan Watkins, will tell you, is this market going to go up forever? Hell no. But my point I'm trying to make is until I see significant technical damage on these markets, and I say it till I'm blue in the face, I say it every single week, until I see that, I've got to buy those pullbacks. I'm not going to try and be the early bear. I'd rather be the late bull. Okay, being the early bear in a bull market can be dangerous. Being a late bull in a bull market to me is a lot safer. I will happily be a slightly late bear once we're in a bear market. Ryan, I know you're listening. When you come on in just a second, I want to ask your opinion on that because that's the way it is. And I hate buying this market as high. Hence, I will use different vehicles to accomplish my goals by exposing myself less through something like options. Okay, so again, we did have that follow-up, but a nice bounce back on the market. It's not over today as well. Like I say, inflation gauge comes in hotter than expected. Another inflation gauge today. Topping off that, companies paid much higher prices to producers in April as well. The producer price index worked. The consumer price index rose yesterday. And the PPI, or the producer price index, also rose by 0.6% last month as well. I was just looking at it. Go check it out. Home builders, everywhere you look, home builders, building. Man, you go see what $50,000 worth of lumber gets you today. About 2.5 houses. A year ago, about 10. That puts it into perspective. $50,000 of lumber is not going as far for the people who need it to produce in the commercial world. Just think about that. $50,000 of lumber right now will build about 2 single family homes, 2 and a bit. About a year ago, 10. Go put that in perspective. The cost of everything is going up. Things to think about from a fundamental point of view. Crypto market tumbles after Tesla stops car purchases with Bitcoin. Man, I never know what's going on with those guys. Big investors, then they stop using it. Is that a sign that Musk is maybe cashing out? Isn't quite as much of a bull on crypto as he's been saying he is? I don't know. But again, doesn't help Tesla in any respect. I don't think anything can help Tesla right now. I see more down to down. The Colonial Pipeline is going to restart after ransomware attack, breathing a lot of sighs of relief. Big fuel runs going all across the country. I must ask Ryan about that because he called me and said, dude, go get some gas because it's crazy down here in Georgia. Up here in the Northeast, not too bad right now, but I still went and got some gas. Nevertheless, man, it is scary how much we rely on technology. And SoftBank's son says he expects even more massive returns after blowout earnings as well. SoftBank CEO Masayoshi Son told CNBC he expects to see even more exits from companies with the Visions Funds portfolio to go public. I want to create an ecosystem where we would have multiple companies going for IPOs. Man, it's all good when you're on the top, right? There we go. Does it mean anything to us as technical traders? Not necessarily, but it's important to understand also all of these fundamentals that do drive price behind the scenes as well. Hey, Amikara, good to see you as well. A few people coming on the show, a little bit late to the party, but it's all good. At least you are here. That is the most important thing. That was my lightning 15-minute summary. I have to give that bit a name. Help me out. That 15 minutes, I go bam, 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 trying to get as much information out. What are we going to call it? I don't want to call it a lightning round because I think that might have been done before. But any suggestions for what we can call that opening 15 minutes? I don't know. The 15-minute breakout. That is a strategy that we use. The 15-minute opening range breakout. Well, that's the 15-minute opening range take stock live breakout. Maybe we'll call it that. I don't know. I can be a goofy so-and-so sometimes. Man, I have too much fun doing this. But okay, if you can't have fun doing things that you love, then you might as well quit right there. I know a man who does things that he loves. And he loves coming on this show and he loves presenting with me. Ladies and gentlemen, my guest today, the established, the renowned, my brother-in-arms here, Mr. Ryan Watkins. How are you, sir?
I'm great. How you doing, Sam?
I'm doing very good. You're a lot more somber than me. I don't know. I just feel like I took a little bit of an energy pill before we started today. What do you think? The 15-minute opening range breakout? That would be.
You're onto something there. I think that would work.
Stockabillaburb. I
It's
like
just like
that,
the
Hollis.
trade tactic, you know.
Stockabillaburb. I like that. The 15-minute Stockabillaburb, Hollis is saying right now on the live chat. That's going up there with it as well. Man, yeah, Georgia, did you get your fuel? Because I know you're down there. It's been going a little bit crazy down in the country.
I didn't actually. I was out and about, and that's every gas station was completely out and closed up. And I'm like thinking, hey, who would actually have fuel at this point? And I thought, let's try Costco. Because they just opened up where I'm at, and it's like, hey, they're new. Maybe not many people know about them, so let me go there. Nope, they were open. They had fuel, but the line was just unbelievable. I've never seen a gas line like that before. So I'm like, I'm out of here. I'm going back home. So, and I'm not one to worry about that kind of stuff. It's like, hey, look, I'm good here. It's in God's hands. Whatever happens. I'm just going to ride that storm out and go back. I got a half a fuel tank, so I'm okay with that. And,
you kind of want to be at home as much as you can.
Thankfully, I work from home. I don't really have to drive anywhere. My wife doesn't have to. We don't really drive much.
Nice,
we're both at home here with the kids and stuff. So,
It's good
Other
to
than
walk.
maybe the occasional gymnastics class for my girl, but but we don't
I was
drive
going to
too
say,
much.
for
So
you or for your little one, because I can't quite picture you in a leotard. So it's
no, that's a scary thought, man.
Ryan's got
That's a
to go
scary
to his
thought.
gym class. Woohoo! Excellent.
Yeah.
Good. Hey, thank you
Gymnastics
for the.
class, right?
Oh, lovely, lovely. Thank you, Holly. Said Stockabilla blurb. I like it. Stockabilla blurb. I love that's a
There you
mouthful.
go.
I'm
Yeah,
trying to
yeah.
get it.
The
So again,
lightning blurb.
we saw it today. Big surf. Before we get into today's subject, we're going to be talking about the top 5 questions you should be asking for planning for
Yeah,
retirement. And when we get into
important
that,
topic.
yeah, what a great topic.
Yeah.
And love that. I love that absolutely. No matter where you are in the world as well. I think something for everybody to think about here. But again, let's just quickly talk about some of the other things in the news today. Inflation. I was looking at those figures on lumber. One of our students shared that. Crazy. This time a year ago, $50,000 worth of lumber would have built you about a home builder about 10 single family homes at a wholesale cost, right? Today, about 2.5. How crazy is that?
That's nuts.
Inflation's hitting everything right now.
Yeah.
To me, it feels like if there's anything that's going to truly bring this market down, or not even bring it down, like I know this thing needs a reset, Ryan, and I've said it till I'm blue in the face, but again, I'd rather be the late bull and enjoy the trend than try and be the early bear who's constantly fighting the trend. I learned that the hard way. I think
Me too.
inflation could be a major factor in this in the long run. What about you?
I do. I think it'll continue to go up a little bit more. At least maybe a lot more. I don't know. But I'll say this. This was I don't know, somewhere around 2019, early 2020 or something. I just saw a little uptick in it. And one of the techniques I use to monitor this type of stuff is look at inflationary type of investment products. Copper, like you mentioned, lumber. That's a big one too. Tips, you can use that as well. But that, tips is great, but it's more geared towards unexpected inflation, which is fine too. We can invest in that as if need be. And one of the things that I did back then was I saw that uptick starting to rise up, and I said, okay, that's inflation's getting strength. Let me do a little bit of a rebalance rotation there. So I added some more on the commodity side and the inflation side to help defend against that if it did go higher, and it has gone higher. So that portion of the portfolios has done well. And that's just one way to defend against that stuff. You can do it in the futures market too, as you're a futures trader, so you can invest in or trade those types of futures products that are tied to inflation. Mainly, I mean, look at these commodities. You got grains, soybeans, corn, all the agricultural type of products out there that we buy. You go to a store, Costco. For me, I'm a Costco guy. I go there and do some of my shopping, and a lot of the products that we buy have those ingredients in it: soybeans, corn, wheat, all that stuff. Sugar. You buy a box of cereal these days, the number one ingredient is sugar. So we try to stay away from that one. But it's inflationary, no doubt about it. And those lumber prices, those stats that you threw out there, that's incredible.
It really is crazy.
I mean, that's just like, wow, that is a lot. It really is a big jump in price.
And then what the initial reaction therefore is going to be. It's not they're going to be, that's going to cut our profit line down. No, it's going to be, with everything that's going on, people are prepared to spend even more for houses. So guess what? I'll just hike my prices up even further. Because we were looking at it, and as you know, we've been in the subject of looking to move, and we've been doing a ton of research. We're trying to do this diligently, my family and I. And one of the long things is getting into bidding wars, on resale of homes, existing homes. So one of the things we looked at, we were like, well, hey, maybe we go for a new build. Maybe we go from off-plan construction and calm it down. Even they're getting in bidding wars on that now, which is kind of unheard of. Again, it screams to me, Ryan, of just things getting out of control. It screams to me of just people just kind of losing their head. And when you're getting in that kind of world, I like to just step back and go, because I always feel that calm and cool heads prevail. What do you think about that?
I would agree. In fact, I've been through a few of these different types of markets. The first one that I went through was the big tech boom,
right?
Where I got caught up into that exuberance, that buy, panic buy mentality, fear of missing opportunity. So I just buy whatever I could buy, and so I got caught up into that, and my account grew really fast. And but when the tech bubble burst, so did my account, and so did my ego. And so it was a great learning experience to be able to go through something like that. So when I see those types of things, I agree. It's like, keep a cool head on yourself here and just think logically about this. Where do you want to buy? I know me, I don't want to buy the highs up there. I wait for those pullbacks, and like we've had recently here, and then start acquiring. And it's the same thing with real estate. I don't want to buy these screaming high prices like this when everyone's into this bidding war. That's a seller's market, not a buyer's market. If you're a seller, you can write your own check for almost here, so
Right.
that is the time to be the seller, where you can take major advantage of that. Just like if you bought a stock or futures, forex, whatever, and you had this big huge run up over months or years, it's a great time to sell,
It really
or at
is.
least close to that time.
It really is. And you know what baffles me, and I want to get onto our main subject, but this is such an important topic that we're talking about here. In my neighborhood, I live in a great little community right on the lake and everything. And like one of my, neighbors just sold his house $25,000 bid over asking price. And he'd already jumped his asking price up, and then another 25. And they're like, woohoo, look how much money I've made. And I don't like to be the devil's advocate. I don't like to pour cold water over things, but this is how my business like brain acts. I'm like, that's great. I'm like, so did you buy a cheaper house for the next house? And he's like, well, what do you mean? I'm like, did you buy a cheaper house? And he goes, well, of course not. I bought an even bigger place. And I'm like, okay. So, well, I made so much money. I said, yeah, but then obviously your house has gone up by this amount, so that one's gone up by that amount, right?
Right. What are you netting?
And it's like, yeah, well, my mortgage is up by about $1,000 a month, but we really want it. So I'm thinking, well, have you really made money because you've ended up taking more profit out to spend even more on the next? I say the people who are truly benefiting from this, and you said it right, this is a seller's market, okay? The people who are reinvesting, making money in it right now are people who maybe have property portfolios to say, hey, I'm generating income on my portfolio. Maybe I want to cash one of these things out. Take a lump of and then rebalance the portfolio, which is actually something I'm doing in the UK right now, cashing in a couple of one of my houses because I never expected it to go up the way it has. So I'm trying to sell it because I'm probably not going to get this opportunity again. And it's in a pretty, tough area where it's hard to get that appreciation to then redistribute those finances. Whereas if I'm selling the house that I live in right now, I need another freaking house to live in. So I'm going to end up costing more for that. So for me, I'm a little bit of like, I want to sit tight and smell, enjoy the smell of the roses, know it's good and wait for it on my terms as well. Like Joseph was just asking, I don't want to be upside down with your new mortgage. If anything, I'd say great time to refinance on your existing mortgage and, pay the banks a little bit less. That's what it seems like to me. One thing I was saying, do you feel, and I'd love to answer this question because it was asked, I love the live questions when they come in, so thank you for sharing, but Joseph also asking, Ryan, do you think FCX is a good inflation play as well right now as we're on the subject before we talk about our top 5?
FCX, let me pull it up right now. It's had quite a run. I'm looking at the chart of it right now.
I'm going to pull it up with you as well so we can look at it together, okay?
If I just go back to March 2020, it was down about $5. And right now it's at about $42. So it has had a humongous
Look at the run on that. Now there it is on the weekly chart. I've got it right there for you.
There you go. There it is right there. Ooh. So this gets back down to is it a good time to buy, right? And it goes back to what we were talking about earlier is I don't want to buy when it's screaming high up like that. That's the time to start unloading, taking some profits on that, at least some. So yeah, it certainly could go higher, but if someone's already in that, that's a great spot to start unloading and taking some profit, if not the whole thing. That's just how I would look at that right there.
I just look at it, this concern, and I've got, me, I go out to those big charts. I got this monthly area, $45-$50 is a huge thing. I mean, I'd say if you were lucky enough to have been buying this as a $5-$10 stock, or even on this run up when we took out this previous transitional area around 20, great. I mean, what could one do? Take some profit. If you still believe in it, take some profit, write some covered calls, let somebody else have the right to buy it, maybe up at 55 or 60, rent the stock out like you would a house. People forget this. You can treat your stocks and your assets just like a house, right? It's prime real estate. Right now, it's at that peak. So I think it could be a play, but I'd like to see this in a pullback. I mean, if anything, I'm cheap as chips. So 25, 30, I'd like to see that $15 lower, then get on the long side of things a little bit more. I know what you're going to say on this right now. I mean, I'll even be more inclined to maybe buy some puts on it right now because, again, the market's already factored that in, and that's the thing. So long term, I see it, but I just don't like where it is, Ryan. You know,
Well, the other thing too is inflation's been the talk of the town for quite some time now. It's not new news. This has been around for a while here, and so you can see there's a big run up on this. And if anyone doesn't know, this is Freeport McMoRan, and they do mining and mineral properties and things of that nature for copper, gold, silver, metals, and things of that nature. So from that standpoint, yeah, there is an inflationary play on it.
Yeah.
To answer the viewer's question. So yes, it is tied to inflation to some degree or another here. I would personally prefer a more pure inflationary play, like buy copper futures or even an ETF if there's enough liquidity, corn, wheat, soybeans, things like that. So you could take long positions on the actual direct futures contract or an ETF, or an option on it would be a good way to go too. Again, assuming there's enough liquidity. So that's my first preference on that. And then the second preference would be a stock like this that has some natural tie in with inflation.
Yeah, exactly. I hope that answers your question as well. Hollis was asking, would you take profits on FCX type stocks like NEM? Again, based on where they are, I don't think it can hurt to take some profit on things. Profits don't take themselves. Look at the charts, take a look at the extension, see where they're at. You have to kind of think about it in these respects. And again, I look at this and I'm seeing on here right now, we're at a major resistance area on NEM right now. That gives me a little bit of a cause for concern when I see things like this. I'm like, if anything, take some profit on it. Book some, write some covered calls. And there's all these different things you could do as well. The point to make on this is you've got to think about relatively where you're buying. You buy this now, you're buying after the move. It's never going to hurt you, because here's the thing. I'd rather see someone on a big move like this, Ryan, having taken a decent ton of profit, take the freaking profit. And if it kind of goes high, you can always get back in when it shows you strength. But it's not money in the bank until it's money in the bank, and too many people they don't pay themselves, do they, Ryan? That's the thing.
Right. You only receive that profit if you actually sell that long position. You don't get it if you hold on to it. It's not a realized gain, and that's the whole point, is getting that realized gain. Now, I look at a chart like this and I say that's a little more encouraging to have more upside potential, because it's gone up into that resistance area. It's had a pullback. It was a very shallow pullback, not much of a sell-off really. And then it's come right back up into there with strength. So getting back to what you were saying is, take some profit when it goes in there. However, if that thing breaks out above, you have a reason to get right back in on the next pullback, or even a breakout above that. So I'm with you too. that is an area to take profit on that thing. But that is more bullish than we're looking at Freeport McMoRan, at least chart-wise, technically speaking, anyway.
Sure.
And so bullish-wise, I would put that before Freeport McMoRan.
Absolutely. And to answer Peggy's question as well, do ETFs pay dividends? Yes, typically. And most of them, unlike kind of doing it on a yearly basis, mostly they'll pay dividends on the stocks that are held within those funds, and they'll typically pay those on a quarterly basis. It's not the same for everyone, but that's typically how that goes as well, okay, based on the holdings within that ETF. Love the questions. I mean, doesn't it just make it so much fun? I love it when we have the questions like this. It just makes it so interactive. So keep them coming, guys. We've got about 20 minutes, to discuss now our topic for today, and I think this really segues beautifully in to the things that we've been talking about. And you put together some great material for the guys that I'd really like to talk about today, Ryan, as well, about our top 5 questions, to be asking when it comes to retirement, okay, and what we should be really looking at on here as well. And I'm going to start, I think, when they say a picture says 1,000 words, okay? Yeah. A picture says 1,000 words. Well, let's just talk about this. Here we go.
Yeah.
Here it is. You versus retirement. All right, I've moved Ryan and me down into the corners on here. This is how it typically feels for most people. I mean, you could see somebody right now in their 40s or 50s and they've been struggling. It's not like it was. It's harder and harder. Most people feel like this. I can relate to that. People just come in and they're like, this is tough. Can we do something about it, Ryan? That's the question. Does it have to be this scenario?
Well, I guess the question is, who is who in that picture, right?
Right. I know who I want to be.
It depends who is who, I guess, is really what it comes down to, because some people are in a really great spot to retire, and other people are not, And the other thing to consider too is Well, where is someone in their retirement journey? I mean, or is someone younger and they're building towards it?
Yep.
Or is it someone who's already retired? Those are two completely different scenarios, of wants and needs. And, there's always that to keep in mind as well.
So let's go take a look at this because, and again, we put a lot of information. I wanted to go full screen on this together, what we've got. And again, some important questions that we put together for anybody on this. And again, we love to make this show as informative as possible on here as well. Let's go through this, okay? And again, hopefully everyone at home, you can all see this as it's broadcast right now. First of all, what age do you actually want to retire? This is a big question. How long do you want to plan for? Does your spouse know what you also know? Does your spouse know what to you also? I think I maybe got I think I got a typo.
That's on me. That one's on me, Sam.
Does your spouse have the same goals? Are they supportive is the question that we have on here, right, as well. And also there's a question of, are you already retired? Because again, you could already be retired right now working in a position where you've got a bigger lump to work with. But is that lump working the right way for you is the question, isn't it, Ryan? Is it working the most effective way? How will you make your savings and investments last? How will you invest? Are you going to do it yourself? Or maybe you're going to pay somebody else to do it, which can often be a pretty scary thing. What will you actually invest in? This is a big question as well, because again, there's more to the world than just mutual funds, right? There's so much more out there as well that you can do. You've got equities, bonds, notes, currencies, real estate, all these things. You could be a business owner. Like part of me having a business could be my retirement, and for many, many people, a lot of different things. And then I think this is a really big one as well. I'm going to move my head out of the way just a little bit here so you can see it. How confident do you actually feel in what you're doing? That's a great question because, I always ask the question, you may be in it because you've been told to be in it, but how confident do you feel about being in it as well, right? Some massive, massive, massive questions on here for anybody. And again, I want to take time so you can start asking us. Now, Ryan and I are on the show. We got like 25 minutes. We can't solve all of your retirement questions, but there's a lot there to think about. Do most people in your experience, Ryan, spend enough time asking these questions, or do they just not know about what questions to actually ask? Is a little
I would agree with the latter there. They don't know what to ask, and so they don't ask.
That's it.
Or they might ask some real basic general kind of questions, but they just don't have the depth of knowledge to even know what question to ask someone, and so it's kind of scary because you're talking about someone's life savings that they are preparing for. One day they will be able to successfully retire and have their money last longer than them.
That's the goal. That's the goal. Your money outliving you, right? Not the other way around. And hopefully onto your family, your children, your grandchildren, and so on as well. So we've got some really, and also, and it's funny, we're saying sometimes you don't know what's around the corner. You could be forced into retirement through disability, as Hollis is saying on here, through a crisis. We've been doing a number of webinars called the Crisis Proof Business. A crisis could be anything. It could be divorce. It could be sickness. It could be a loss of job. I think the more planning you do now, the better. I think it can be overwhelming for a lot of people, though, Ryan, because they look at this and go, oh, God, I'm so behind. Better to start doing something than doing nothing and hoping it's going to correct itself, right? That's the thing. And that's really what the goal is here. So to break this down into some more easy, manageable chunks, here we are here with a little top 5. I'm going to highlight these, and Ryan, I know you're like the professional you are, going to shed some light on these things for us as well. Number 5, take it seriously. Let's talk about that.
So this has been, I think, a very common issue for a lot of people is they either, assuming, of course, they want to retire. Some people just don't want to retire. They want to keep working every day of their life. So that I get that. But for the people that do want to retire and they actually have that goal, you can't just take this as a casual thing or a hobby thing. You really do need to put some time, some energy behind it. Teach yourself or learn from someone who's done this and has the right path laid out. But you got to take it seriously. It's not worth it.
Yeah.
If you mess this up, if you don't take it seriously, I mean, think of what the goal in mind that you have here. And, if you don't start planning now, it's not going to plan itself.
No,
you're not going to get the results, unless you put some time and energy and effort into it. And it may not take a whole lot of time or a lot of energy and effort. especially if you're learning from someone that knows what they're doing and can help guide you in that way. That time is really reduced. And but you got to take it seriously. There's no doubt about that. And in whether you're already retired, the big question is, how do I know my money's going to last?
Yeah.
How do I know that?
Yeah.
And I don't just mean like, oh, it'll probably last.
Do you? Right. What are the
How
statistics?
do you know? How do you know?
What are the statistics?
Right, exactly.
Showing you on here.
Yeah, what's the actual number? You
Right.
know, the actual probability. Is it 95%? Is it 12%? You know what I mean?
Yeah.
That's a big difference.
Yeah, and again, it could be forced upon you, like Hollis is saying in a thing, right? That's a massive thing in your opinion. She says, in my honest opinion, this is the major issue for many Americans. Their only question is, what do I do now? Through disability, through a layoff or whatever it is, what do I do now? That's why taking it seriously now before that kind of stuff happens is going to start to help you move in this the right way, you know, rather than the wrong way, to start giving you that opportunity to, like, again, have the answers to the questions before the market throws those questions at you. That's really it, isn't it, Ryan? You know?
Yeah. And think of scenarios. You might not think of all the scenarios, but just think, I'm however old now. What if 10 or 20, 30 years from now, such and such happens? Maybe it is disability. Maybe it's, you know, lose a job, or there's something going on there. You know, I mean, there's all kinds of scenarios that could happen, or crises that could happen. So let's at least think of some of those and say, what is at least some ways that I can prevent those from happening, or at least if they do happen, I'm covered.
Right. Exactly. You know? Exactly. It's all about having that, you know, being covered, making sure that, you know, you're in that right spot, that, again, you've done everything. I think you've got to ask yourself, what am I doing? I also have that conversation about, what am I doing to be out of this situation? Most people, they sleepwalk around. Just, they bury their head in the sand. And I hate this saying, but I like this saying, because while it's a harsh saying, and people go, oh, and they get a bit uncomfortable when I say it, it's reality. Most people bury their head in the sand. And the problem is, you bury your head in the sand, you're on your knees. And being on your knees is not a good position. You're not coming from a place of strength. You're not coming from a place of defense. And that's a really, really important thing as well. Thank you for sharing that article as well, Hollis. Anyone looking at the show right now, some great resources being shared in this interactive edition, which is always an interactive edition here of Take Stock Live. Let's move on to then our next one here, Ryan. And, you know, number 4. Okay, so let's go on to here. Number 4. What is number 4 do we have on here? Let's take a look and click on through to see it. Drawdowns. Top 5 things you've got to ask yourself about drawdowns. What's a drawdown, Ryan? And what can we do to control that aspect?
A drawdown is one of the most critical factors, just in investing in general. So that includes retirement, obviously, but a drawdown would be this, for example. Let's say we start with $100,000, okay, and the market drops. You know, for whatever reason, there's some kind of, you know, collapse or correction, something like that. Let's say it drops 20%, okay. So then we went from $100,000, we lost 20%, so we got $80,000 in our account. That's a 20% drawdown, or $20,000 drawdown. Now, every investment account will have drawdowns. That's a given, okay? So that is something that everyone needs to understand, that every account will have a drawdown when you're invested in the markets.
Right. You can't get away from that. You have to just accept
Right. No one's going to get away from that. However, having low drawdowns is so much easier to recover from than a huge drawdown. For example, and I've been through this myself, you know, when I said the tech bubble burst, the NASDAQ dropped 81% from that tech bubble burst. Mm-hmm. That's a game over scenario. I mean, that'll just wipe out some.
In 2000, the tech bubble.
Right, in 2000, right, yeah. So that was call it 80%, right?
Yeah.
What someone needs to recover just to get back to break even from that is a 400% return. I mean, just think about that. A 400% return just to get to break even. Now, how long is that going to take? And most people are invested in mutual funds that were higher feed, really high fee mutual funds. So how long is that going to take them to really get back? And people often will say, well, look, my account's back up to break even. No, you've been adding money month after month on the 1st or 15th of every month into your account to help boost those returns. But the actual return on your investment has not recovered. So when you're constantly pushing more money into it, of course, it's going to boost those returns, which is fine. That's good. We can add more money. There's nothing wrong with that. We want to do that, you know. But when you have a very low drawdown, like a 10% or 15%, something like that, those get recovered much easier. But it's not just the recovery from a mathematical concept and you're, growing your account quicker and more often, but it comes down to a psychological or even an emotional thing too. Because if you have a 50% drawdown in your account, which if you've been invested for any decent length of time, you've probably gone through that once or twice. That's emotionally devastating to look at your retirement and say, I just lost half. I mean, imagine someone who is like days away from retirement right before the big debacle, the subprime crisis in 2008.
Oh my God.
And now they're thinking, I can't retire.
You're just born in the wrong year.
Right.
You could have been born a year earlier and you'd have been fine.
That's what it comes down to.
You could have been born a year earlier.
Yeah.
You could have been born a year earlier and you would have been fine. And that's scary, how much are you leaving to fate? You put these together for us to take a look, because here was where we are, and it is a mountain to climb, isn't it?
It is.
Right, from the start, from here to here, and here's our end goal that we're looking to shoot for. Absolutely on here, but it becomes more and more challenging as time goes on. I mean, there are some of those. That's just it. To put it in perspective, what you talked about, not steady, consistent growth. The dot-com crisis, 45%, subprime price, 51%, the global pandemic, 30%. How much time are you wasting during these major dips? That's the thing that people seem to just not understand. And, if anything, unless you're taking these areas that we're seeing and really using these potentially as good buying opportunities and protecting on the way up, like protecting your gains before the drop, like now, protect your gains, right? Before the market then does that,
right? Those
drawdowns, it's almost like you're pushing Atlas, pushing the stone to the top of the mountain and then let it roll all the way back and just going through that constant, hamster in a wheel scenario, right? Which is, a constant just, issue for so many people. Again, in any stage of this as well. Let's take a look on here. Here's just another little chart you put together for us as well here, Ryan, as well. You can see some of those drawdowns from a period of time. Want to tell us a little bit about this?
Yeah, sure. So the red line there, that graph represents actual drawdowns going back to about 1970 or so.
Yeah.
And look right about 74, 75. I mean, that's a pretty healthy size drawdown right there, about 45 or so percent.
Yeah.
I mean, it's terrible to go through those things. And it takes a long time to recover, not just time that an investor is losing.
Yep. Yeah.
But also the emotional trauma, if you will, that they're going through all that, worrying about, am I going to make it? Am I going to make it to retirement? And that's just one. I mean, you can look how many drawdowns there are, some bigger, some smaller, but every investor will have drawdowns. The important thing here is we as poised, professional, prudent investors here need to keep those drawdowns very small.
We do.
Now, normally what happens is if you go for low drawdowns, that means you don't get the growth that someone needs. Okay, that's usually the case here.
That's the
what we have is a really great balance between strong growth with very low drawdowns. I mean, we have those allocations with our, in our wealth program, Stockability. We teach on Wednesdays in what we call the Wealth Wednesdays, GTS. So we have, and I'll show you guys an example coming up in a few more slides of actually really good outperforming growth with significantly less drawdowns and significantly less volatility, which is all the up and down, back and forth type of stuff.
Nice. Absolutely. And it's that balance because, again, using multiple asset classes could simply be the answer to do that as well. That's why I think too many people are just stuck in the world of holding their stocks, in the world of holding that one position and not realizing, what else is actually out there too. What else that they can do to protect them. We don't have to just necessarily close a position. What we can actually maybe do is just manage the position a little bit more effectively.
And that's all it is sometimes. It's just to manage it. And it might only be once a month kind of thing for an hour. And that's it.
That's it. Manage,
really
be
simple
active.
Stuff.
And again, we've been looking at it, and with the work we work at it, and it's, some people want to be more active and manage it monthly, and some people want to be a little bit more passive and manage it quarterly, but at least do something. Because most people just sit and do nothing. And that for me is where the problems really lie as well. So let's be aware of drawdowns. Let's go on over now to number 3, the big looming number 3. What is number 3 on our list? Asset allocation, what we were just talking about, like
Yeah.
having an investment model on here as well. Let's talk through this, Ryan. Tell me, I'll be your wingman.
So this is really interesting. There's been many studies done in the investment world, and one of them in particular was what is the actual performance of an asset or of an investment coming from?
Yes.
You know, like for example, if you look at the S&P 500, a large portion of the growth actually and the performance comes from the dividends. You know, there's a portion of that
I
helps
see,
fuel the
yes.
growth. So, you know, hey, that helps, right? Performance factors from an investment. And what the study revealed was 91% of its performance was directly correlated with asset allocation.
91.
Now that is a staggeringly high number for one factor.
Right.
One single factor gives 91% of the performance there.
Uh-huh.
And everything else was only 9%.
Wow.
So that tells us asset allocation is a huge part of this. And so it needs attention spent to it.
Absolutely. And
there's just some examples right
there.
There's
a lot of choice
there
here
are
as well.
many. There's a lot of choices there.
Right.
And that's not even the full list, by the way. But
take your pick. Now let's look at what you've highlighted here, okay? So we can go. So we've got US-based equities. Let's have it into groups here. Equities which are international and outside of the US. Interest rates. Corporate rates as well. Global interest rates. Real estate that we actually love having here as well. Metals. Currencies, both fiat and crypto, fiat being paper money, crypto being crypto, and then other as well. So what have you got? 1, 2, 3, 4, 5, 6, 7, 8, just under 10 different areas, as I'd like to call them as well. You know, 10 different areas, which is pretty neat. The choice is there. Again, does somebody need a bit of every bit of this, or is it more important, Ryan, to focus on an area and pick your weapons of choice? You know, because it could be overwhelming for a lot of people, right?
It absolutely can easily be overwhelming for someone, and I would not recommend a bit of everything because there's a tremendous amount of correlation. I mean, if you just look at US based equities there's a ton of correlation, even from large to small to micro to mid and so on. So there is an allocation that's quote unquote just right.
Right.
But it also would depend, and this is where it gets very individualized, depend on that person's target that they're trying to reach. Is someone trying to get 8% per year, 13-14% per year, or are they perfectly fine with 6 or 7% per year? I mean,
Correct.
Everyone is different. They're in a different scenario. So a lot of that different allocation will matter on someone's individual goals. And the asset allocations that we use are basically geared towards that, where we have, here's something that's very conservative for the people that are in that category, here's something that's more aggressive, and then everywhere in between.
Exactly. You got a couple of here's on performance as well, you know. So
this is a great example of what I was talking about earlier. So we have different investment models that we teach and to our students, and the Stockability Gold model is one of our models. And I just simply compared that against the S&P 500, which is the most common equity benchmark in the world. And so the first one, CAGR, that stands for compounded annual growth rate. So that's the growth that you're getting in the account. The gold model comes in at 11.5% versus a buy and hold of the S&P 500, 10%. So, you know, a lot of people say, you know, well, did you outperform the S&P? That's their benchmark, you know?
Yeah.
Yes, our gold model absolutely is doing that, not by a staggeringly high amount, but it's outperforming that. Now, the other side to this, though, it's not just the CAGR that we want to outperform. There's some other very important factors, one of which is standard deviation right there. Now, if no one knows what that means, the standard deviation is the up and down volatility of your equity curve growth. So the higher the number, like the S&P has 14.5% basically, so it's really moving up and down, up and down, up and down pretty fast. Whereas the gold model is 10.7, so it's a smoother ride.
It's a more stable ship. So instead of kind of having
more
these
stable,
wild swings, we're just looking for something a little bit more like this, you know,
right.
A gentle ride, less volatility, for example. You know?
So the lower the number, the better. So think of it as the gold model is like you're cruising. You're in cruise control on the highway in a Cadillac.
Yeah.
Versus the S&P, you're buying in a Jeep in the mountains. You know, it's a bumpy ride, right?
Great example.
And then best year, worst year. But the other really important factor is maximum drawdown.
Yeah.
And the gold model has a very low drawdown at 15.8%, whereas the S&P has a gut-wrenching 50.9%. That and I look at something like this, that is really the first thing that I personally look for is the max drawdown. The second would be the KGAR, and third is standard deviation. Yeah, there you go.
There's my technical take on it. Okay.
That works for
Low
me.
max drawdowns.
That sums it up right there.
15% maximum drawdown during that given period of time versus a 50% maximum drawdown. Remember, you got to then make that money back. That's the other thing as well. You've only got to make 100% to recover from that 50% drawdown.
So let me give you a boxing analogy here. The gold model is a boxer that is in better shape, performs better, can hit, move, and dance around the ring much faster than the opponent. But when the S&P punches the gold model, it just kind of wobbles a little bit.
Yeah.
And then it's right back ready to fight again. Whereas when the gold model punches the S&P, it is out for the count. I mean, it is like a Mike Tyson uppercut right to the chin. Like you're done. Game over.
Glass jaw.
Yeah, exactly. I mean, you're not going to recover from that kind of a huge wipeout of your account like that.
Exactly. It's great. Such useful information there, Ryan. Number 2, my friend. Number 2. What's on number 2? Let's see what we have on here. Safe withdrawal rates, SWR. Spend a couple of minutes on it. For anybody not heard safe withdrawal rates, explain this concept to us, and I know we've got a nice little confidence comparison we can look at right here as well.
Yeah, sure. So safe withdrawal rate is basically how much money can we withdraw from our funds safely, and safely basically means to ensure that money will last our lifetime. So I put up 2 comparisons here. So the green investment model, that's another investment model that we have. I use the same funds here, so 400,000 on both. The one on the right, the popular investment model, I'm not going to name the name on it, but it's a very well-written, publicized, popular investment model. And you can compare any other popular investment model out there you want. And I believe the green will pretty well outperform all of them.
Yep.
And so we just did an apples to apples comparison with the retirement fund, but then we went to withdrawal rate. The popular investment model was 4%, which is pretty much your standard 4% withdrawal rate that every financial advisor out there is preaching. Okay. And the withdrawal rate on our green model is 5.25. So we have a higher withdrawal rate. That means we're going to get more money each month.
Lovely.
So that comes out to be about $1,750 per month, or 21 grand a year. Now, for some people, that might be too much or not enough. I mean, look, it's so individualized, right? So it's just a simple math example here, but 21 grand a year versus the popular investment model. I'm sorry, that's little typo there. Sorry, that's another one of my little typos there. Yeah, so there you go.
More importantly,
so $1,300 per month on that one right there.
Yeah.
Okay, so safe withdrawal rate for that one's 3.9.
Right.
And on the green model, it's 5.8.
Yeah, they're the 2 big numbers.
So really,
there.
The popular investment model, we were doing 4%, but that's too high. The safe withdrawal rate's lower than that at 3.9. But the green investment model, I was just withdrawing 5.25, but we could go all the way up to 5.8 and be quote unquote safe, meaning that money will last all the way for that full 30-year term.
Nice.
And if we needed more than 30 years, fine, we can plan for that too, But it would at least say, look, we can withdraw 5.8%, which is significantly more than 3.9% there, for up to 30 years.
Exactly. That's the number that we're looking at here, this 5.8 safe withdrawal rate. A big thing. And remember, this is just based on one account as well, right? Let's not forget that too. Right. You may have other accounts over, that you're using as well, Ryan, that are something that you're saying, hey, I'm going to do some income, investing on short-term plays. That's perfectly fine as well. But it's keeping that nest egg in really there. Glad this is time well spent. It's an amazing show. Give Ryan the props for that, Hollis, as well. Thank you. And Joseph, we'll get to your question right at the end. Joseph was asking, how often do you need to rebalance a portfolio? We'll get to that just at the end of this as well. Give you a little bit of an idea of that too. So awesome stuff on this. Well, this gives we're at question number 1 then of all of them. Okay, the number 1 question we need to start asking ourselves right now, friends, is this. And here we go. Success rate. People are so, wrapped up in being right, and I know, but we need success in what we're doing to as a measurement, as a gauge of what we're doing the right thing, right? So let's look at this. It comes down to our confidence level, Ryan.
Yeah. So that same example, now I've just added the confidence level, which is success rate. The green model has a 95% success rate, meaning you have a 95% probability your money will last the full 30-year term versus 74% for the popular investment model. Now, that's still pretty high. I mean, 74%, that's not bad. That's actually pretty decent. But I'm sorry, I cannot go to my wife and say, hey, sweetheart, I got this really great popular investment model. And if I die first and you and the kids are left over, well, you have a 74% chance the money will last.
Yes. Yeah.
Versus, hey, look, I got this 95%er. And
That's
we can
one.
actually do a couple tweaks and make it 99.89%.
Huge. Absolutely.
What
huge.
a difference.
Massive.
And not just in the performance of that allocation, but in the confidence that someone has that their retirement will last.
Yeah, exactly. I mean,
it's not just retirement. I mean, you can get into other things too, like perpetual withdrawal rate, which is if you want to make this thing last, generations, maybe you want to leave it to a charity or your kids or your grandchildren, then we can do a confidence level for what's called a perpetual withdrawal rate, PWR. And now that'll be a little bit lower. It might be like, 5.3% or something like that. But at least someone will know, boy, with the money I have saved up, if I withdraw whatever that perpetual withdrawal rate is, that thing will last perpetually, and my kids will have it, my grandkids will have it, and you can, or charity or whatever you want to do with it. It's your money, do what you want with it. But that's another factor to look at as well. We're talking about not just the safe withdrawal rate, but the confidence, meaning put a number to it.
Yeah.
Is it 95%? Is it 50%? I mean, what is it? And there's, software that we use in our Wealth Wednesdays to calculate precisely what these actual confidence levels are.
It's all good when you got the numbers to back it up. That's what helps. I mean, this seems like a very structured, planned, almost boring. Yeah. I hate to say it, but it really should be, right? It's no point going on a roller coaster with the most important money that you've got. And I've always said in this world, there's plenty of other areas to have excitement and fun. You'll have a lot more excitement and fun if you're well planned and well structured for a healthy, happy retirement in that respect as well. So wonderful stuff, Ryan. I love it. We've got time for a couple of questions that we can answer as well. We've allocated some time. So firstly, Joseph was saying, how often do you need to rebalance a portfolio? I mean, to me, is that based on individual needs, what you're trying to do, or based on the market? It's a great question.
It actually is. So two parts to this. Yes, the markets, how they're moving and stuff like that, but really it comes down to the investment model that someone is using. Some investment models, you really don't need to rebalance much at all. It might be once every year or two. Some it might be once every 6 months on average. Other investment models require it to be at least checked once a month to see if it needs rebalancing or not. So it just depends on how active that investment model is. And, the investor can make that choice of how active they want to be. But what I would not suggest is kind of the traditional way of thinking is rebalance once a year on January 1st or your birthday or like an anniversary date or some just date, you know what I mean? That's not going to be advantageous to the investor out there. So if you're going to rebalance, do it when there's a large spread differential.
Makes sense.
Between, like, for example, let's say equities are just like sky high, you're making a ton of money, and gold is like way down here or something like that, and there's a big spread between the two. That's when you want to rebalance it, not on a particular date like your anniversary or whatever,
which is
birthday or
scary
something.
Because that's what most people do as well. Because most of the advisors and people who are managing this money, they're not really looking at it. They know that they're getting their commission, they're getting their paycheck. And again, if anyone listening at this show thinks, wow, you've got it in for advisors, I don't. I'm not angry at them. I'm annoyed at the system that just has encouraged that kind of behavior. That's the frustrating part of it, really.
Right. And to be fair to them, they're not trained on this.
They're not.
They're
not
trained
on
this. Most of them anyway. Most of them. I mean, if someone was maybe a trader before or something like that, or investor, they have that experience, but most don't.
Exactly.
That's not really their core business, is to be that investment manager.
Well, the responsibility
to be a financial advisor or a broker or whatever their role is. So yeah, it's not like anything against
I think the
them.
responsibility,
it's just not their role.
I think the responsibility was of the firm who employed them to put the right person in there, and then the firm doesn't care. So it's the top of the chain that's making those bad decisions. So It's like, don't shoot the messenger. It's that scenario as well.
Right,
and I want to make that very clear for anybody looking at the show here. We don't have an axe to grind with the individuals. A lot of these guys, with the tools that they've been given, they're probably doing the best job that they can possibly do. It's just that they've never been given the level of understanding and education and skill set to take this to the next level for their clients. And that responsibility falls on the actual institution behind it, on the corporation behind it. They're the ones who should be, sitting back and ashamed, but they don't care. They're the ones making the most money, more than their own advisors who are working for them as well. The other question we've got here says, if you don't hold enough, this is a great question as well on the show, if you don't hold enough shares, of a particular stock to write the covered call, are there other things that we can do? Because, remember, options are 1 for 100 shares, Ryan. So for anybody saying, well, I don't have, maybe I have 50 shares. Anything else I can do? My instinct would be to say, hey, you could hedge it with a futures position or in a related market, doing an option on something related. What are your thoughts on that?
Yeah, there's some ways where you can, let's call it, mimic what it is that you're trying to do. So it might be, buying the actual call on it, like a long-term call, maybe
like a synthetic, or something
like that.
Like
yeah, or you can do a synthetic type of thing,
yeah.
and that'd probably be a good way to go for someone that knows how to do that stuff. So there are some ways around that to take advantage of that. The other thing too is consider the product you're trading. So as an example, let's say you're trading an ETF that represents the US stock market, and if that ETF is $300 per share, well, you're probably not going to be able to do much with it. But if you're focused more on lower share ETFs that still give you that same, product or whatever, then there might be a little way to go around doing that. But, again, you still got to get those 100 shares.
Yeah.
Okay. So, I would just say you might be kind of stuck in some ways until you can get to that 100 share mark. But if not, if these other ways of doing it, like doing synthetics and other things of that nature, then sure, you can go that path. But if not, I'd say, okay, either learn how to do that stuff or just simply keep building until you can get those 100 shares.
Great question. Great answer. Great answer. Really appreciate that, man. What a show. Thank you, man. I mean, I know, we talked about this and you put in so much effort on this. I think just so informative. And Take Stock Live is evolving. We're evolving more and more and more into this, resource and information as our audience and viewership is increasing. We're going to get more subjects. Feel free at any time to reach out to us and let us know what you would like to hear. We always put the details at the end of the show on any way you can reach out to us. We've got more special guests. I've actually got your performance coach, Christy Geiger, coming on the show in a couple of weeks as well, who we were fortunate enough to have in the previous one-day event that we did, enhancing your performance. So it'd be great to have her. Maybe I'll have both of you on here for a little bit.
I'll have to watch that. She's great to listen to. So informative.
Really, really. I loved every minute of that. So it'd be
just
lovely.
Ask her tons of questions. I'll get like a free session. So it'll work out great.
I think that's the thing. We'll both be getting something out there as to do that as well.
Yeah.
In the interest of time, we're at the top of the hour, past the top of the hour. We knew this would be a long show, but that's the beauty of having your own show that you produce, direct, edit yourself, and can control the broadcast stuff. You can do it as long as you're or as you want.
Right.
It wouldn't be Take Stock Live without your call, my put. Ryan,
that's right. Yeah,
let's go to the charts. What are you feeling, my friend?
I just got a little Microsoft, so I'm going to have to put my money where my mouth is here. So I just acquired some Microsoft, so I'll go with that for a bullish position, Microsoft.
Bullish position in Microsoft as well. What a run this thing has had. I mean, you can see the uptrend is alive and well. Going to be zooming in here right now. On the monthly charts, to me, it just looks like a pullback as normal. Pullback is business on this as well. Lovely little pullback on this. I got to say, and I love talking to my guests about this as well. Seems like a bit of an aggressive one for you, Ryan, on this one. Have you been eyeballing this one? Because I know what you're like. I mean, I'm looking at this and I'm seeing, although you got it and you've had a nice gap up on here, if you've missed the boat on it, I mean, I got to say, I look at this chart down here on the day chart, I'd love it a little bit cheaper. Do you think there's a chance it could come down a bit before it goes up, or have I maybe missed the boat on this, Ryan?
So this was an interesting play. I've been eyeballing this one for a while now, waiting for the next pullback. And now that we got the pullback, I'm like, there we are, pullback in an uptrend, I buy.
Yeah.
So I actually started doing this in two ways. I call it, this is what's called scaling in. So I started buying, day or two days yesterday.
Yep.
And so that's the first tranche, call it, all right? So I just like saying that word, but the first lot,
Great
right?
word. I love it.
The first entry. And it's not a full position, so
Right.
it's a smaller position. But if it does go lower, and I kind of hope it does a little bit more, yeah, right down in there, then I'll add to that position, which again is called scaling in. So scaling into
Nice.
that uptrend. So the first tranche was yesterday. The second tranche will be if it does go lower. Now, if it does not go lower and rallies up higher, okay,
You're
then
still in it.
I got half my position on that
Got
thing
it.
at least. So at
Got
least
it.
I'll get something out of it. And there you go. So, you know, that's my play on that one. Just waiting for it to either come down a little bit lower to add to that second tranche, or just hey,
I
if it goes
like
up
it.
higher, then it goes up higher. I'll manage it from there.
I love how you've explained the thinking on that as well. I mean, I'm bullish on the Qs. I got myself some QQQ calls as well. Hopefully that's going to
Yeah,
set in with that quite nicely and see. As I was saying on the show as well, I mean, again, the market took a real punch to the face yesterday, so you're not always going to see the bounce back that, you want to see. But, I mean, still looking pretty good on here. Like that Dow looking strong. I don't expect it to recover all of its ground. Markets tend to go up slower, and cover less ground on the upside than they do on the downside. So I'm not phased by that little panic and sell off. But I like the play, and it lines up quite nicely with the three kings as we see right now. Your Dow Jones, as we talked about at the earlier part of the show, S&P made that nice pullback, recovering nicely today as well. And again, if we go take a look at the Nasdaq itself and see how that's going as well, struggling a little bit. But again, I think tech's been so overdone. There's a lot of negativity in tech right now, and I think that's just comes from a lot of people who just missed the boat on it. So
yeah.
again, overall, I'm seeing the upside on it. But one market I got to say, and I appreciate that one, is that I've been talking a lot about in my guided trade sessions is Roku. And I'm just looking at this, I'm like, oh, I've been beating on Tesla pretty badly lately, by the way. And let's have a quick look, shall we? I mean, I am still bearish on Tesla. Regular viewers of the show will know last week I was bearish on Tesla. This week I'm still bearish on Tesla. I'll just show you going back to the longer term charts. I look at that weekly chart and I'm like, eek, I see nothing on Tesla down to around this 450 mark. I mean, I'm even thinking of buying some puts on this thing. I want to see it take out these previous lows right here, which to me don't offer a lot for it. I like it down on 50, but I don't want to just repeat what I said last week, so I do still remain bearish on Tesla. But for this week, Roku, I got to say, another one here I'm just looking at right now, Ryan, and it doesn't seem, let's just get the thing, it just doesn't seem pretty when I look at this. It's not really had the bounce back I'd have expected on here. I just smell the round numbers on here. Let me just do this. Let's just kind of auto zoom on here so you can see enough of the chart for everybody to see. Looking at the weekly chart, it's having a bit of a recovery, but again, I just see this and I'm looking lower, and I gotta say 200, 225 to me is there. It feels like, there's a little bit of buying activity being absorbed around here, a little bit of indecision, a lot of a snapback on this. But again, the fact that we're putting in those lower lows, putting in those lower highs, when I see this chart, I can't help but be, relatively bearish on it. I look at the monthly chart, it tells me the same picture. I look at this, Ryan, and I'm just like, wow, it looks even worse. Too far, too fast, and again, I'd say to this, I like it, but I like it a whole lot lower as well. Let's just look at the daily chart of this so we can see in a little bit more detail as well. Not the 15-minute, the daily. Here we go. And again, I can see just those subtle signs on here of that. Let's just say, look, if we go on here, the lower lows, lower highs, lower lows, lower highs, lower lows. And again, this rejection at around this 340 mark. To me, I think it's just paving the way for lower. Am I being a bit too negative, Ryan? You've always had a good objective opinion on things. What's your thoughts on Roku?
No, I think you're spot on. I mean, it's just bearish on all accounts, and I would assume that would keep going lower as well.
It looks very similar to the Tesla chart as well. I think some of those tech stocks just got overdone, and I think that's weighing a little bit on the Nasdaq. But let's remember, the overall tech sector has the big boys. It has the Amazons, it has the Apples, it has the Facebooks with that heavy weighting to prop it up. And that's why, to answer the earlier question, I'd rather go with that tech index for this buying opportunity rather than the individual stocks, just based on what we're seeing in this market right now as well. So whole lot of great information on there as well. Ryan, what a show is all I'm going to say on here. I mean, wow, so much information.
Covered a lot of ground.
I mean, it's great. How are the Wealth Wednesdays going? I mean, I've been hearing great feedback from people. Like, you've been really it feels to me like the Wealth Wednesdays you've been doing in the guided trade sessions are a passion project for you in some way.
They are. I think it's very much needed for many people. I really believe that. There are
seems like we might have lost Ryan on the show. This is the live This is the nature of live training. We got Ryan who's just pausing on here as well, but it seems that we might have lost Ryan on that end. Well, Ryan was about to say just how much he enjoys doing our live sessions and in doing our Wealth Wednesdays. But it looks like we lost Ryan, but that's the beautiful thing about live shows. This is occasionally going to happen. All I'm going to say is, thank goodness we lost him now at the end of the show, rather than right at the start of the show. I'm going to say on behalf, his passion project is the Wealth Wednesdays over at Stockability. You want to find out more about our Wealth Wednesdays, you want to find out more about a little bit of what we do, let's go over to the website and I will show you how as well, okay? Here we are. Let's go to the website, stockability.com. You will see at the top of the website on here on our page as well. And if you're interested in seeing that, there's his big smiling face right down here at the bottom. There he is. You'll see the Trustpilot reviews of just how we're rocking and rolling right now. Very happy doing what we're doing. And if you want to explore what our education is all about, just click on the education button right here at the top of the page. All of our programs, everything that we do is all here for you. And if you're new to this show and just simply do not know where to begin, but are intrigued enough to want to find out more, my advice is go click on here, Trading and Investing Orientation. You like Ryan, you like what you hear from me and some of the other guests on here, accelerate your trading and investing education with our on-demand program with over 15 hours of lessons from myself, Ryan, and the whole Stockability team, and actually get to work with our student consultants to build your own blueprint moving forward. It's an absolute bargain at $99 on here, and we work with you all through it as well. And if you're not even ready to take that step, just go click on resources. And guys, under resources, we have a ton of Stockability material for you to start delving into, from how to start day trading, latest articles, peruse what we've got. We've got stuff to keep you busy for weeks, tons of information, tons of content. And again, you can also go to our YouTube channel and find out more. We've literally done our very best to give you as much as we possibly can to show you a little bit about what we do. And guys, if you want to get a little bit more live interaction, scroll down to the front of the homepage here, all the way down, and you can join me Wednesday. This coming Wednesday, just 6 days away, where you can join me for a special complimentary webinar hosted by me, yours truly, on 5 tips to start trading with a small account. We're going to be talking futures, options, how those particular markets are geared perfectly towards starting. And people go, what's a small account? Maybe just $1,000, couple of $1,000, could be less. But that's what we're going to be doing on there, focusing on how to start with a small account. Come join me for that. It's 2 p.m. Eastern, 7 p.m. London time this coming Wednesday. Go click on register today. I'd love to see you there live. I'll be answering all your questions and giving you my personal top 5 tips to begin trading with a small account. The following week, we've got a complimentary webinar, a focus on Forex with a brand new coach at Stockability who we're going to be showcasing in that, purely Forex focused, on how you can use that for both income, wealth in your portfolios, diversification, income, tons of things as well. And then Mr. Ryan Watkins is back on June 8th for Can You Afford to Retire, with a session he did this week. If you missed that one, you can watch it again with brand new material in here. Go register for them, see what we do, come spend some time with us. We love what we do, and we're really sure that you love what we do as well. It's been wow, what a show. I hope you got something out of today. Let me give a big shout out to all the viewers on here. Hollis, Peggy, Joseph on here, Rod, Letitia, everyone else on here, Amit, Peggy, I said that as well. Angelica, I'm reading everybody out here. Charles, Louise and Max, love you both. Great to see you on the show as always. And if I didn't get to shout your name, I'm sorry, I'm trying to do this live and I lost my main man Ryan, but at least, you know, it happened right at the end. So we didn't miss out on all those beautiful nuggets on there as well. London time, you got it, mate. I'm always going to be a Londoner. I may be living here in the US, but I'm always going to be a Londoner too. A US man and a London man, just like my little boy as well. Guys, what a show. Great. Next week, we've got more in store for you as well. Plenty of things to be covering. We'll start advertising what that's all about as well. And if you just stick around till the end, I'm going to show you how you can get in touch with the show as well. Reach out to us, give us suggestions. Take Stock Live is moving in a brand new direction as we expand the show weekly. We bring more and more education and information to you to show you what we do, how to do it, and to navigate the waters of the financial world to give you peace of mind and just overall much happier life. It's all about hitting your goals, and we're committed to helping you hit those goals as well. Take Stock Live Live has been powered by Stockability.com. We are here every Thursday at noon. This show is also recorded, so you can go and look at all the recordings of this or any of the other shows here on Facebook Live, or you can go to the Stockability YouTube channel where you can see all of the backdated shows as well and peruse some of our other videos and other tips and tricks as well. Big announcement, Take Stock Live will be on Friday of next week. Friday of next week, May 21st. Next Thursday, there will be no Take Stock Live. The show will be broadcast on Friday of next week at noon Eastern. I'm telling you now because I don't want you to turn up on Thursday and not see the show. We will be broadcasting on Friday with another special guest. Please join us for that show as well. Just occasionally we will change the date. Next Friday is going to have a special edition, wrapping up the end of the week with a weekend and week ahead look, okay, into June and beyond. We've got a real special one lined up for you. I hope you can join us then. In the meantime, all I can say is have a wonderful rest of your week. Guys, my name's Sam Evans. I've been your host, joined by the impeccable Ryan Watkins. Have a great week. Have a safe week. Have a fun week as well. Stay safe out there, and I'll see you next Friday for Take Stock Live. Have a good one. Take care. God bless. Bye-bye.